Today we're talking about two strategies to use when the market is going up. When you trade options, you've got a lot of ways that you can set up your trades to make a profit. But first you have to determine the direction of the market trend. And today we're going to be talking about an up market. And once you decide that, that narrows down the choices that you can make for your trades. Your first goal, always recognize the trend of the market and recognize what the ticker you've decided to trade, how it's doing. The second goal is to set up your trade to make the most money in the least amount of time. The market generally goes up more than it goes down, so let's focus on an up market to begin with. And before we begin, I want to jump in and say thank you to all you folks that are following me. And if you're new, please go out and hit the like button or subscribe so you'll get notification every time I put out a new video. Here's some choices in an uptrending market of how you can trade options. The first one is simple: buy a call. When you buy a call and the market is going up, that call moves further and further into the money and you're able to sell it for a higher price. Pretty simple. Some decisions you've got to make when you buy a call is one, what expiration period are you going to trade in? And this is important because of theta. We've talked about theta before, and I'll go over it a little more. Every day, theta is eating away at the premium that you bought something for. So let's say you decided to buy a call in this week. So you bought it on Monday, it's going to expire by Friday. Well, you bought it, and all week long, theta is eating and nibbling at that premium. And the last day, it really eats at it and it goes down fast. On Friday, that position expires worthless. So the only time you can really make money when you have a short period like that is if the stock is really zooming up fast, because you still got the time decay, but it's going up fast and moving into the money fast. So that will work there, but it really has to be zooming up if you're going a short period like that. Here's a phrase I want you all to put in your memory banks. When you buy an option, time decay is your enemy. So the second decision you got to make is what strike are you going to buy? And we've talked about theta, that's one Greek. Well, we're going to introduce you to another Greek now, and that's delta. Delta is how much your premium, your option premium, changes for every dollar that the stock, the underlying stock, moves up or down. So an example of this would be if your delta was a delta 47, and the stock went up $1, you would gain 47 cents on a call option just because of the delta. Notice on the option chain that the delta at the money is usually between 45 to 50 cents. And as the price goes up, that position goes up, and you'll see that if it goes high enough, it gets to that 1-to-1 position, where if the stock moves $1, your option price moves $1 also. So that is one thing, buying a call, those are your considerations. Now let's look at selling a put. Remember when I said that buying a put, that time decay was your enemy? Well, when you sell premium, time decay is your friend. Because again, you sold that premium and time decay is nibbling at it and it's getting less and less, and when you have to buy it back, you can buy it for less price and you make money again. So there's only one problem with selling premium, and that is the risk. And actually the margin requirements too. So when you buy an option, this is buying an option, your only risk is whatever that premium cost you. That's the max you can lose. So once that's gone, that's your risk. So if you bought a premium for $2.50 and there are 100 shares of in every contract, that would be $2.50 times 100. Your total risk would be $2.50. When you sell an option, your risk is actually the underlying stock price. So if you sold a premium at, let's say, the $135 strike, you would be at risk for $135 for each share. Times 100, that would be $13,500 for one contract. That's a lot of money to be at risk for. That also becomes your margin requirement. And remember, the margin requirement is what your trading platform sets aside in a reserve. You can't trade it until the position is closed. They're protecting themselves. There's an easy way to lessen the risk, and that's by selling a credit put vertical. So first of all, what is a vertical? A vertical is where you have bought a position and sold another position in the same expiration period. So if you sell something closer to at the money, you're bringing in more premium, and then you buy something a little further out of the money, pay less premium, and so you get to keep the difference in the two premiums, the sold and the bought. Now, why does that lessen your risk? Well, on the one you sold, you have an obligation. If somebody decides to put it to you, you have to buy it at whatever strike it is. So in the case we just talked about, you've got to buy the stock for $135 a share, $13,500 per contract, but you can then do the same thing to somebody else with the strike that you bought. So let's say you bought the $134 strike. You could force somebody else to buy that from you. That would put $13,400 in your pocket. You've just spent $13,500 to buy the stock, so you would only lose $100 in there. And that's the beauty of having a vertical. You lessen your risk, you lessen your margin. Today, I introduced you to some new concepts and elaborated on some ones we had covered before. We had talked about theta before, time decay, but we introduced delta to you today. Delta is whatever the option price is, the movement of it when the stock goes up or down $1. We talked about in the money, out of the money, and at the money. We talked a little bit about what kind of trades to do in an up market. You can either buy a call, or you can sell a put, or you can sell a credit vertical put. So we talked about verticals a little bit. Along with that, we talked about risk management and your margin requirements. Thanks so much for listening. And if you want to dive deeper into your education on options, please take advantage of our 2-week free trial offer over at investingbuddies.com. I'll see you next week when we go over some of the technical tools I use for determining what stock to trade and when to enter and when to exit. Let me know in the comments section what you like about this video and any questions you would like me to address in future videos. And thank you so much for listening.